Hey everyone, welcome back to Sip and Talk. This is EP421-2.
Great to be here. Hey, before we really dive in today, I have to mention something kind of wild our friend Mickey is doing.
Oh yeah, Mickey's experiment. I heard about this. He's taking, what, 2 million Taiwan dollars?
Yep, 2 million, virtually, thankfully.
Okay, good. Phew.
But yeah, he's putting this virtual cash into a portfolio of stocks that basically scream, who would ever buy this?
Right. His whole criteria is like no tech, future looks bleak, the more I look, the more I want to run away, that kind of thing.
Exactly. He called them financial time bombs and dying chronic patients. Even stable death candidates. It's pretty grim.
2 million Taiwan dollars, though, even virtual. And it's a long-term thing.
Yeah, he's letting it run for a full year. The goal is basically to see just how bad it can get, or maybe if he can kind of slap the market in the face, prove it wrong somehow.
So how is he picking these? Just vibes? No, he's actually got a system, which makes it more interesting. He's looking at the Taiwan 0050 index. That's like their top 50 blue chip companies, kind of like the S&P 500 here. And he picked the 10 stocks from that list that he thinks are the most worrisome.
And the criteria for worrisome are?
Pretty brutal, actually. Like first, the whole industry structure has to be collapsing. Think industries just getting hollowed out.
Okay, makes sense.
Second, high risk of being totally replaced by AI or some new tech. Third, they're getting hammered by policy changes, environmental rules, rising costs, you name it.
And the last one?
Risk of getting kicked out of the 0050 index altogether, which is a big visibility hit.
Wow. So he's really aiming for the bottom of the barrel, but like the blue chip bottom?
Exactly. And it raises this really big question, right? Is this genius, contrarian investing, buying when everyone else hates it? Or is he just walking straight into what they call a value trap?
Where it's cheap for a reason.
Yeah.
Like it really is going down.
Precisely. Especially now when all the hype, all the money seems to be chasing AI and tech stocks, pushing those valuations sky high.
He's zigging while everyone else sags. Hard.
And he had this quote that stuck with me too. If everyone knows it's terrible, will it really be terrible?
I love that. It's a great question. And just to be clear, it is virtual money, right? Because otherwise...
100% virtual. Otherwise, yeah, he's either crazy or way richer than we thought.
Okay, good. Well, we'll definitely have to check back in a year and see how his anti-portfolio does, see if it beats the index.
Sure. It's going to be fascinating.
And actually, that whole tension between the high-flying tech dreams and the struggles of these older companies, it kind of sets up what we're talking about today, doesn't it?
Perfectly. Because we need to look at what happens when all that global money does chase the AI craze. What are the roadblocks? What are the hidden issues?
We've got economics, we've got tech news, market stuff, and even something about how our brains work.
That's right. All connected. So let's start with the big tech picture. There's this massive cloud computing deal brewing. We're talking Alphabet, Google, and Anthropic.
Anthropic, the AI company.
Okay.
And this is a big deal.
Potentially huge, multi-billion-dollar scale. But it's not just about renting servers. It's about what kind of servers. Specifically, Google's tensor processing units, their TPUs.
Okay. Google's custom AI chips, not just general purpose stuff like NVIDIA GPUs.
Exactly. TPUs are built from the ground up for machine learning, for training, and running these enormous AI models. Giving Anthropic access to those gives Google a serious edge.
And the market noticed, right? Alphabet stock ticked up.
Yeah, up about 2-3% on the news. But here's where it gets really interesting and maybe a little awkward.
How so?
Amazon. Amazon is already a massive investor in Anthropic. They pledged something like $8 billion.
$8 billion. Wow, okay.
Right. And Anthropic uses Amazon's cloud platform, AWS Bedrock, for developers to access their models. So why are they talking to Google?
Good question. Is it just that they need so much computing power that even Amazon can't supply it all?
That could definitely be part of it. These models are incredibly power hungry. Maybe they just have to diversify their suppliers out of sheer technical need.
Or is there maybe some friction in that Amazon relationship?
That's the other possibility everyone's wondering about. It's probably a bit of both, honestly.
Yeah.
But the big takeaway for you listening is that Anthropic seems really constrained by supply.
They need more power, more chips now.
Desperately.
Yeah.
Their CEO's apparently been touring the Middle East looking for capital, yes, but also physical computing capacity. If Amazon's big plans for custom chips or data centers are hitting delays, well, Anthropic can't wait. They might need Google's TPUs right now.
Which leads us straight into this bigger AI supply crisis, doesn't it? It's not just about who has the best chip design.
Not at all. We're hitting real-world physical limits. Forget the silicon for a second. Think about what you need to actually run these AI factories, these data centers.
Okay. What are we talking about?
It's like a trilemma, a three-way shortage. First, basic materials. Concrete, steel, all the stuff you need to actually build the buildings. There are shortages.
Okay, didn't think of on concrete.
Second, skilled labor. You need people who know how to build and maintain these incredibly complex facilities. Also hard to find enough of them.
And the third? Let me guess.
Power. Electricity. This is the big one right now.
Just not enough grid capacity.
Not even close. The existing electrical grids in many places simply cannot handle the sheer gigawatts of power needed for the data centers that are already planned, let alone the ones coming down the pike.
Wow. So the AI boom could literally stall because we can't plug it in.
It's a very real risk. And it's completely changing the game. Suddenly, utility companies, energy providers, they're critical players in the AI revolution. There are talks about huge deals for nuclear power or other alternative sources just to feed the AI beast.
Without power, those fancy AI chips are just expensive rocks.
Exactly. I heard this story. Apparently, some data center builders are being told by their local utility, look, you can build out your NVIDIA cluster or your Google TPU cluster, but you don't have enough power allocation for both.
Seriously, they have to choose.
That's the reality of the infrastructure crunch. So when you hear about Google possibly supplying Anthropic, you also have to ask, where's that power going to come from?
Man, okay. But speaking of Google and advanced computing, they did have some positive news on a different front, right? Quantum computing.
They did? A potentially significant step. They reported running an algorithm on their quantum chip called Willow Creek that performed a specific task 13,000 times faster than a classical supercomputer.
13,000 times faster. That sounds reality-bending.
It's a huge number. But, context is key with quantum. It's not going to replace your laptop anytime soon.
Right. It's for very specific kinds of problems.
Exactly. Really complex mathematical optimization problems. This result is important because it's a proof of concept. It shows quantum can genuinely outperform our best current tech for certain things.
And the potential applications. Where would this actually be useful?
Think simulations, especially in things like drug discovery, material science, maybe even complex financial modeling down the road.
Like figuring out how a new drug molecule will interact in the body.
Precisely. That involves calculating potentially trillions of parameters. Classical computers choke on that scale. Quantum computers, in theory, could handle it, drastically speeding up the search for new medicines or materials. It's a long way off for widespread use, but the potential is enormous.
Okay, so that's the far future. Let's pull back to today's corporate reality. Earnings season, Netflix took a hit.
Did. Stock dropped pretty sharply, about 8.5%. Their worst post-earnings slide in a couple of years, actually.
Ouch. But I thought their numbers were mostly okay.
They were. That's the weird part. The underlying performance was strong. Good subscriber growth, hits like their K-pop content doing well, ad revenue picking up steam.
So why the drop?
It seems to boil down to a one-off issue, a tax dispute with Brazil that dinged their Q3 earnings number specifically. Analysts were basically saying, ignore that noise, the core business looks good.
And they're pretty bullish on the advertising side going forward.
Very bullish. Some forecasts see their ad revenue tripling to over like $9 billion by 2030. So the long-term growth story, especially with ads, still seems intact.
But the real drama around Netflix wasn't just the earnings, right? It was M&A buzz, mergers and acquisitions.
Yes, huge speculation. Netflix was floated as a potential buyer for parts of Warner Bros. Discovery WBD.
Interesting. What parts?
Well, crucially, the CEO made it super clear what they don't want. Zero interest in legacy media networks. So no CNN, no TNT, none of that traditional cable stuff.
They don't want the baggage.
Exactly. They want the engine.
Yeah.
The valuable intellectual property, IP, the actual movie and TV studios, maybe the physical production lots. It's all about content creation and ownership.
Smart. Focus on the future, not the past.
And it seems WBD is playing hardball. They reportedly turned down a low offer from Paramount and Skydance. Looks like they're trying to start a bidding war.
So Paramount Skydance buying WBD is still maybe the most likely outcome.
Probably. But now you've got Netflix, maybe even Comcast, sniffing around looking to maybe cherry-pick the best assets if WBD decides to break itself up instead of a full merger. It's getting complicated.
Okay, shifting gears to enterprise software, Workday. Their CEO sounded pretty fired up.
Oh, yeah. Carl Eschenbach. He basically came out swinging, saying Workday is underappreciated and undervalued.
Fighting back against what?
Against this narrative he called overblown and false. The idea that AI is just going to completely disrupt and eat established software companies like theirs.
And Workday does. HR and finance software, right, for big companies.
Yeah, huge footprint, used by like 65% of the Fortune 500. Their argument is, hey, we're not just using AI, we're training our own AI on our unique data.
They have the data advantage, the moat.
Right. Data from 75 million users, tons of transactions. He claims 75% of their customers are already using their AI tools and getting real value, not just some superficial chatbot layer.
And they put their money where their mouth is, buyback.
They did. Announced a share buyback. Now, there were some crazy numbers floating around initially, but the actual figure is $500 million. Still significant, shows confidence.
$500 million is still serious. But is everyone actually getting value from AI yet? I hear mixed things.
That's the crucial context. There was this broader study showing something like 62% of corporate AI spending is stuck in pilot purgatory.
Pilot purgatory, I like that, meaning lots of experiments, not much payoff.
Exactly. Half the companies in the study couldn't show a clear return on investment, ROI, from their AI projects yet.
So Workday might be confident, but the rest of the industry is still figuring it out.
Pretty much. Workday acknowledges its early days, lots of experimentation. They expect big cost savings and productivity gains eventually, but proving that ROI today is clearly a challenge for many.
And other software news. Meta cutting AI jobs. It sounds weird.
It does seem counterintuitive, right? In the middle of this supposed AI talent war, Meta cuts 600 jobs in its AI division. The explanation was to streamline decision-making, reduce layers. Still, a bit surprising.
And IBM?
IBM shares dipped a bit. The main drag was slower growth in their Red Hat unit. Red Hat's important as their open-source software arm, key to hybrid cloud strategies. Growth was okay, 14%, but it was a slowdown. Might signal some caution in enterprise spending.
That caution theme seems to pop up elsewhere, too, especially with tariffs.
Definitely. We saw Mattel and Texas Instruments stocks both fall after giving disappointing forecasts. And they pointed fingers directly at macro policy risk.
Mattel, the toy company. How do tariffs hit them?
Well, think about where most toys are made. China, right?
Yeah, overwhelmingly.
So with the uncertainty about potential future Trump tariffs on Chinese goods, retailers are getting nervous. They're delaying orders because they don't know what the final cost will be. It gums up the whole supply chain.
Just the threat is enough to cause problems.
Exactly. And Texas Instruments saw something similar from industrial companies. They called it wait-and-see mode. Nobody wants to make big commitments when trade policy is up in the air. It creates this macro fog that makes planning really hard.
What about travel and hospitality? Hilton?
Kind of a mixed bag there. Hilton lowered its overall outlook because demand for their sort of mid-range U.S. hotels seems to be slowing down.
People cutting back a bit.
Maybe. But they did raise some other financial guidance, suggesting they're managing costs well. But then you look at the luxury end.
Still strong.
Incredibly strong. A company called Montage International, super high-end resorts, they're seeing average nightly rates over $1,200. So the wealthy are still spending big on travel. Labor costs are hitting them too, though.
Okay, before we get to the electric car elephant in the room, Mickey's irrational market bet seems less crazy when you look at this next one. Meme stocks are back.
Oh boy, are they ever. Beyond Meat, remember them? Yeah. Plant-based meat company.
Vaguely. Stock did poorly after the initial hype.
Terribly. But suddenly, it went on this insane 4-day rally, up almost 1,300%. The stock price went up 8 times in just 5 trading sessions.
1,300%. What on earth caused that? Amazing news. Breakthrough product.
Nope. Apparently, it was sparked by a post on Reddit. Not from some analyst, but from a real estate developer.
You cannot be serious. A Reddit post.
That seems to be the catalyst. Now, there's a technical factor, too. The stock had enormous short interest. Like 64% of the available shares were being shorted, meaning people were betting heavily it would fall further.
The short squeeze.
Classic short squeeze potential. Price starts rising, shorters are forced to buy back shares to cut their losses, which pushes the price up even more, creating this feedback loop. Pure speculation, fueled by retail traders.
But the company itself, fundamentally.
Still down 97% from its peak in 2019. So yeah, complete disconnect from reality. Krispy Kreme got caught up in it briefly, too.
It's exactly the kind of madness Mickey is betting against with his terrible stocks.
Wild. Absolute wild. Okay, now, Tesla. Q3 earnings. Always a big one.
How'd they do? Hit or miss?
Kind of both, which is typical Tesla. Adjusted earnings per share, EPS actually missed expectations slightly. 50 cents versus 54 cents expected.
Okay, a miss on profit. Revenue.
Revenue was basically fine, beat estimates slightly at $28.1 billion. But the huge number, the one that got everyone's attention, was free cash flow. FCF.
Let me guess, massive beat.
Absolute crushed it. $3.99 billion. The expectation was only $1.25 billion. So almost $4 billion in free cash flow, up 46% from last year.
Wow, how'd they manage that with an EPS miss?
Partly by selling off inventory. Basically turning cars sitting on lots into cash, which is good, but maybe not the same as generating cash purely from new production and sales growth.
And the stock reaction with that huge FCF beat.
Still finished the day lower. Volatile, but down.
Why, if cash flow was so strong?
Because Tesla isn't priced like a normal company. It's priced for absolute perfection. That forward PE ratio is astronomical, like 251 times earnings. So any miss, even a slight EPS miss, and concerns about the core business, they just weigh more heavily given that valuation. Investors demand perfection.
And there are concerns about the core electric vehicle business, right?
Big ones. Losing that $7,500 federal tax credit in the U.S. is a major headwind. That's a straight price increase for many buyers.
Ouch. And Europe?
Europe was worse. Growth was down 20%, which is really bad when you consider the overall EV market in Europe was up 30% in the same period.
So they're losing market share. To who?
To the legacy automakers, VW, BMW, Mercedes, Honda, Kia, who are finally getting serious about EVs, and maybe some brand damage. The constant price cuts, the controversies, might be hurting them.
And the new cheaper Model 3Y didn't help.
Apparently not enough. People were underwhelmed, no glass roof on some models, things like that. Critics are saying Tesla's maybe taking its eye off the ball with the core EV business, which is still hugely profitable to chase these future dreams.
Which brings us to the valuation question. How do analysts even justify that 251 PE?
They basically split it in two. There's the core car and energy business.
Right.
Maybe worth $150 a share. Some estimate.
Okay. And the rest, the other hundreds of dollars in the share price.
That's the premium. The Elon premium or the Hope premium. It's all based on future potential from robots, Optimus, and especially full self-driving, FSD.
And Elon's own pay package is tied to hitting insane targets, right?
Absolutely insane. Like $8.5 trillion market cap, 20 million cars a year, 1 million robots, 1 million robotaxis, all within 10 years. Just staggering goals.
But how realistic is FSD right now compared to the competition?
That's where the skepticism comes in. Waymo, Google's sister company, is generally seen as the leader. They're already running commercial driverless taxi services in 5 cities.
And they use different tech, right? Not just cameras like Tesla.
Right. Waymo, GM's Cruise, most others use a mix LiDAR, radar sensors, and cameras, a hybrid approach.
Whereas Tesla is sticking with cameras only. MML, they call it.
Vision only, yeah. And critics argue that's fundamentally less reliable. Cameras struggle in bad weather, weird lighting. And crucially, it makes safety validation much harder.
How so?
If a vision-only car has an accident, it's really hard to prove to regulators exactly why the AI made the mistake it did. With LiDAR and other sensors, you have more concrete, verifiable data logs. It's a big hurdle for getting widespread approval for truly driverless operation.
Interesting. So contrast Tesla's big FSD dream with Amazon's approach to robotics.
It's a fascinating contrast. Amazon's been using robots for years. They have like 1 million deployed in their warehouses already. But their focus is much more practical, more immediate.
Collaborative robots working alongside humans.
Exactly. And getting tangible ROI right now. They just showed off a new robot called Blue Jay. It's a manipulation robot, meaning it can pick things up.
How capable is it?
Pretty capable. Developed in just over a year using AI, much faster than older systems. And it can already pick and handle over 75% of all the different items Amazon stocks in its warehouses.
Wow. That's immediate efficiency.
Right. Efficiency, safety improvements for workers, productivity gains. Amazon argues this lets them invest more in their people, upskilling them for higher-level tasks. They mentioned training over 700,000 employees.
But the classic question, do robots take jobs?
Amazon's line is that the nature of jobs changes, but they keep creating new ones. They want to eliminate the boring, repetitive tasks, not the workers themselves. History, they argue, shows they continue to grow headcount even as automation increases. We'll see.
Okay, let's pull back again to the bigger economic picture. Some shifts in the banking world. Regulations.
Yeah, this is important for Wall Street. The Fed sort of walked back a tougher bank capital proposal from the Biden era.
Capital requirements, how much cash banks need to hold against their assets.
Exactly. The initial plan called for a big jump, like 19% higher requirements for the biggest banks. The industry pushed back hard.
And the revision?
Much milder. The new outline suggests an increase of only 3% to 7%. So that's way less than 19%, even less than a previous compromise idea of 9%. So the banks are probably breathing a sigh of relief.
And how are banks doing generally? Earnings were okay.
Pretty solid, actually. Fears of a big credit crisis seem to have faded for now, but analysts did point out something important for you listening.
What's up?
This K-shaped recovery thing is still very real. High-income households seem to be doing fine, spending, borrowing. Low to moderate-income households still struggling more. It's uneven.
And the overall market, still choppy.
Definitely volatile.
Yeah.
S&P 500, NASDAQ down recently, tech taking a hit, partly thanks to that Netflix drop we talked about. Small cap stocks, the Russell 2000, are lagging even more, which suggests maybe a lack of broad confidence beyond the big tech names.
What about safe havens? Gold.
Gold had a wild ride. Saw its biggest one-day drop since 2013 recently. Fell 1.5% in just one morning.
Is that a bad sign? People ditching safety?
Probably more of a correction in profit-taking. Gold had a massive run-up, and since it doesn't pay dividends or interest, when it hits highs, people tend to sell some. Doesn't necessarily signal panic, just market dynamics.
Are there any warning signs flashing?
Indicators. Bank of America tracks these 10 internal risk indicators. Things like sentiment, valuations, credit spreads. Apparently, 6 out of 10 are currently triggered.
And historically?
Historically, when you hit 7 triggers, it often signals a market peak or a downturn is near. So we're getting close, according to their dashboard. Things like too much euphoria, big gaps between expensive and cheap stocks, people getting too comfortable with credit risk.
Lots to watch out for then. Inflation reports coming up. Fed decision.
Yep. CPI reports soon. Fed decision about a week away. They're expected to cut rates again. Plus potential Trump Xi meeting, more big tech earnings, lots of potential market movers.
And there's debate about whether the Fed should even cut again, right?
There is. Bill Dudley, former head of the New York Fed, made the point that financial conditions actually look pretty loose already. Stock market's strong, bond yields have fallen, the dollar's weakened, all things that make it easier to borrow and spend. Dudley's basically saying maybe things have eased too much, and the Fed should be careful about cutting rates further after this next expected one. Don't want to overheat things.
And all this happening while the government was shut down?
Yeah, that didn't help.
Well,
the shutdown stretched to 22 days, second longest ever. Messed up paychecks, but also created that macro fog we talked about. Hard for the Fed to make good decisions when government data on inflation or jobs is delayed or unreliable.
Geopolitics still simmering too. Russia sanctions.
Yep, oil prices jumped about 4% on news Alexis. The U.S. is planning a substantial pickup in Russia sanctions and also allowing Ukraine to use some longer-range missiles. Any escalation like that tends to push energy prices up.
Wow, okay, that was a lot. Markets, tech, geopolitics, economics.
It really was. And now, as promised, we're going to take that hard left look. We're going to connect all this market craziness, all this tech hype, all these valuation debates to the thing that actually perceives it all.
The human brain.
Exactly. We need to talk a bit about consciousness, about how we experience reality itself. We can use the work of neuroscientist Anil Seth as a guide here.
Okay. Where do we start? Anesthesia.
He often uses that example, yeah. General anesthesia isn't like sleep. It's like you just cease to exist for a while. It really highlights the fundamental mystery. How does this 3-pound lump of neurons in our skull generate this rich, continuous feeling of being?
It's mind-boggling when you think about it.
Totally. And take color.
Yeah.
We think of red or blue as being out there in the world, properties of objects.
Right. The apple is red.
But scientifically, nope. Color doesn't exist in the physical world. There's just electromagnetic radiation, different wavelengths of light. Your brain takes signals from just 3 types of cone cells in your eyes, sensitive to reddish, greenish, and bluish light, and constructs the experience of color internally.
So the red I see might not be the exact same red you see.
Exactly. Think about colorblindness, or even that weird dress photo from a few years back. Was it blue and black or white and gold? People genuinely saw it differently because their brains were interpreting the ambiguous light differently. Our realities are subjective. Nagel's "what is it like to be a bat?" question.
Okay, so reality is a brain construction, which leads to Seth's big idea, controlled hallucination.
That's the one. It sounds wild, but it's a powerful way to think about perception. The idea is our experience isn't the brain passively reading information from the outside world like a camera.
It's more active.
Much more active. The brain is constantly making predictions or best guesses about what's out there and what's going on inside our own bodies. It's predicting the causes of the noisy, ambiguous sensory signals it receives.
Like forecasting.
Kind of. It generates a prediction, gets sensory feedback, compares the feedback to the prediction, notes the error, and updates the prediction. The content of that constantly updated prediction is what we perceive as reality. It's an inside-out process, not outside-in.
Wow. Okay. So it's like we're hallucinating, but the hallucinations are tethered to reality by our senses.
That's a great way to put it, controlled hallucinations. And this changes how we think about emotions, too.
How so? Like feeling fear?
Yeah. Think about the old James Lange theory. You see a bear, your brain perceives the threat, your body freaks out, heart pounds, adrenaline surges, etc. All right. The emotion of fear isn't something separate that causes those bodily changes. The emotion of fear is your brain's perception and interpretation of those bodily changes happening in the context of seeing the bear. It's the brain inferring, based on these internal signals and that external stimulus, the best explanation is, I'm afraid.
My brain is reading my body to figure out how I feel.
In large part, yes. Which also means the brain isn't really like a computer.
How is it different? People always use that metaphor.
Seth argues it's a bad metaphor because computers have a clear separation between hardware and software. The brain doesn't. It's an organ, evolved to control and regulate a physical body.
Okay. Give me an example.
You can swap out a computer's mouse, the hardware, and the software keeps running the same. But if you go for a hard run, your physical state changes dramatically, and your subjective experience, your mental software, changes right along with it. Brain and body are deeply intertwined.
So our sense of self isn't some fixed thing either.
Probably not. It's more like a collection of processes, perceptions, predictions, feelings of free will, emotions, memories, creating continuity. It's always changing, always being constructed. Which maybe comforting identity is a process, not a fragile object you can lose.
But this leads to some tricky ethical places, especially with new technology.
Absolutely. If our reality and self are constructed predictions, what happens when tech starts messing with the prediction process?
Like digital avatars, AI versions of people.
That's one frontier. Training an AI on someone's voice, writing, maybe even simulated thought patterns, you could create an avatar that feels disturbingly real. What does that mean for identity, especially after someone dies?
Creepy. And brain-computer interfaces. BCIs.
Even more direct. BCIs hold amazing promise for treating paralysis, blindness, Parkinson's. Huge clinical benefits.
So the ethical side, cognitive enhancement.
Right. What if BCIs go beyond restoring function and start enhancing abilities?
Yeah.
And what if they could not just read your intention to move your arm, but potentially influence or even create an intention or a thought?
Whoa. Where does free will go then, if the tech is initiating the thought?
Exactly. It fundamentally challenges our sense of being autonomous agents making our own choices. If technology can subtly shape our brain's predictions, it shapes our reality and our sense of self.
So the takeaway is, we need to understand how our minds work.
Yes, we need to be informed about how our own brains construct experience so we can make conscious, deliberate choices about these powerful technologies we're creating. Protect the conscious self by understanding it.
Man, what a trip. We went from Mickey's contrarian stock picks
through the bottlenecks of the AI boom, the quantum future, the struggles of old industries, meme stock madness,
the contradictions of Tesla, the pragmatism of Amazon robots, economic jitters,
and landed inside our own heads, questioning the nature of reality itself.
It really all ties together, though, doesn't it? Mickey betting against consensus reality.
While the tech market seems priced for a perfect, maybe hallucinated future reality.
Right. The beyond meat surge, pure irrationality, detached from fundamentals. The Tesla valuation demanding perfection, maybe ignoring present headwinds. It's all about perception.
Which brings us back to that controlled hallucination idea. When analysts say the market is priced for perfection, demanding flawless execution from Tesla or massive immediate ROI from AI.
Is that collective belief just a shared hallucination, a market-wide prediction based on hype and hope?
And is it just waiting for some unexpected sensory data, a bad earnings report, a geopolitical shock, a regulatory change to force a massive, painful update to everyone's predictions?
Crashing the hallucination back down to a different reality, that's a really provocative thought to end on.
Definitely something to chew on. And as always, just want to remind everyone listening, what we talk about here on Sip and Talk is meant to provide objective facts and different perspectives for you to explore. We don't criticize any group or nation. We just want to encourage critical, independent thinking.
Absolutely. If you enjoyed this conversation, please do subscribe to Sip and Talk wherever you get your podcasts.
And definitely check out Mickey's YouTube channel. It's called Mickytolife. He'll be tracking that weird anti-portfolio there, plus other fun stuff like liquor tastings and travel vlogs. He's always up to something interesting.
He really is. All right, that's all for this time.
See you next time on Sip and Talk.